Hey, it's Douglas Beck with the Growth Collective. In this video, we're diving into a key question every real estate investor faces. Should you focus on income or growth when approaching a deal? I'll break down the difference, share real-world examples, and help you understand how to align your strategy with your investing goals. But before we jump in, make sure to hit that subscribe button so you don't miss more valuable insights on real estate investing and scaling your business online. Let's get started.
What's more important, income or growth? Do you care more about income in terms of passive income and stable passive income, or growth? And check this out. Here's the secret. If they care more about income, they're probably more keen on a lending type of scenario, to lend to your deal, to be a private lender, to be a private, capital provider in the form of a loan. Income is what comes from loans. Loans create income. Isn't that crazy? Like, think about that. They're providing a loan, they get a stream of income from that loan. But if they're more keen on growth as a capital partner on your deal, then they're probably less interested in income. They're more interested in growing and multiplying the size of their investment. And that comes in the form of risk taking, i.e. equity. So wait a second, we've got income and debt, we've got growth and equity. This is really simple. If you write this on a piece of paper, left-hand column, income and debt. And I'm gonna do we need to have the team help with this, but do an infographic on this. I had a call this morning with somebody and they've got capital to invest from retirement funds. They've got capital from inheritance and different things. And they're looking to figure out where to put that capital. And I'm trying to help them. I'm not their financial advisor, but I'm saying, look, I got opportunities. I can point you in the right direction. You should consider a self-directed. You should consider talking to your financial advisor, which I think he did and will, more about this stuff. But the fact is, if I look at a rental property, a single family home as a rental property, as an example, unless I do improvements, it's just going to be another income stream that also has wealth creation because I own it and it might appreciate over a longer period of time. But if it's already renovated and I just rent it out, for example, then I'm producing an income stream from a piece of real estate that has equity. My equity, we'll say, if I have the capital. Like, so Steve's example, he's got 250 grand, let's say, in that deal, then he needs to look at what kind of return is he getting as a landlord if he's renting it out on his 250. And I'm gonna tell you something. Usually it's not as much as you can get if you go do a fix and flip. We should know this. It's pretty, we know that, but it's also a different kind of risk. But that return that, let's say, Steve gets on his rental property, okay, let's say he's getting 10% a year, which would be great. Let's say he's got 250, 10% is $25,000 a year. Well, that means he's making a couple $1,000 a month net after taxes and stuff like that. He has no debt on the property, we'll say. That's great. But now the question is, can he get that much or better without taking on the responsibility to own the real estate? What do I mean? Well, he could be a private lender. Steve, serious talk. You could take your equity and convert that into liquidity in the form of taking either a loan of your own or somehow contributing it towards buying a note and producing income that has no management involved. Example. So you could take free and clear property that has this much equity and convert that into a income stream called a loan. And you want to probably be in first position if you do something like that to make it like to like, as far as owning the property free and clear. First position loan is kind of a similar type of income level, okay? But it doesn't require the management of the real estate. It doesn't require the complexity and the risk in the real estate. It doesn't require you to pay taxes on the real estate. It requires you to just collect mailbox money. That's what people will say. Now you go over to this side and we've got growth, right? We're in the growth column. So you kind of got similarities. So let's think about this. You got income and loans, and you got people that are generally, I would say, landlords or own real estate in that bucket, okay? Let's just follow me here from the left-hand side. On the right-hand side, we've got growth, appreciation, right? And equity. And this group of people, some of which are in this room, and maybe you have some of this and some of that, which is normal. You're not looking for just set income return. You're not looking for a set, this much per month or this much per year, 10%. You're looking for, like, how do I take my principal and multiply it? But check this out. There's not a good way to do that without taking risk. And the risk is going to be different than the income risk you would take to get income streams. These are kind of obvious statements I'm saying, but I'm going to put this together for you in this way. When I'm talking about who I'm going to partner with, who I'm going to bring into my deal, how do I find capital partners? How do I find people to bring in money to my deal as a buyer, an investor, a lender? I got to ask the question. They say you can't, somebody says they sell snow to Eskimos. Like, it's not about sales. Like, this is just logic right here, okay? If you're going to Alaska and you're trying to sell the Eskimos snow, I don't believe that's a good idea in the first place. What you should really sell them is a snow shovel, okay? Or you sell them a snow blower, okay? But here's what I mean by this. It's kind of a silly joke. What do Eskimos in Alaska need? They need warmth. So maybe you should consider selling them heaters, right? They need something to keep warm. They need something to function. So if I'm looking to offer something to a group called an investor, I'm not going to offer the income stream to the growth investor. I'm not going to offer the growth investor the income stream either. It doesn't logically make sense into the psychology of my risk profile. So I need to understand, and you guys need to understand, if you distinguish. Right now, some of you have this like collapsed, which is normal and how I was for a while, way of looking at this, saying everybody wants to invest in everything. That makes sense. That's the word I love hearing. Makes sense. Does it make sense? What does it make sense? I don't know. It's like the market. The market's, the world is the market. market. I don't know. What is the market? Quote unquote. The market. I love that one. Listen, break it down. Okay. Split it apart into two: income, debt, passive, reliable, certain, consistent, landlords, market, stock market, distributions, dividends, these kinds of things. Over here, you got growth, equity, capital, larger chunks in capital that will grow faster. More experienced, typically investors will go into equity deals, right? A lot of times they've already seen it work well. They've seen it not work well. They know how to evaluate. That's the thing. So if we could distinguish those two buckets for you guys to understand the thinking, the psychology here. Again, don't try to sell an equity deal, or at least don't think that you're going to get an agreement most of the time, an equity opportunity, a fix and flip to a landlord. They don't want to see fix and flips. Landlords that have portfolios typically just want to manage and grow their portfolio and make it more stable, right? And then you got fix and flip investors, like if they're trying to grow, most of them don't really care so much about passive income right now. They're trying to multiply money. So when you offer them like a fix and flip investor, or if you're wholesaling, for example, a fix and flip investor, like a rental property that's got 8%, 10% to like 8%, like I need that in like a couple months. I need like maybe a few months I can get, like I need to see 10, 20, 30% in 6 months or less. You can't do that on rental real estate, right? Residential. Even if you did value add, you still have to go and do something, and now you have to refinance. So that's just some framing for you guys to get the kind of general idea of how you want to distinguish and discern these things, because I've been there and I am there in some ways, still sorting out, right? Our database, for example, right now, we're sorting out a lot of ways. These people are more keen on this thing. These people are more keen on that thing. And the thing is, if you have things to offer those different people, then you need to be more laser focused on what matters the most to them, because you want to help them get what they believe is great deal, great offer, great return. Don't burn through those relationships because you're offering them the wrong thing. What's more valuable than real estate? What is the most valuable real estate that you own? Not a piece of house, not a house. What's the most valuable piece of real estate that we own? Our body, our mind, our mouths. Okay. If we get really good at understanding how we can think, and like it's like Think and Grow Rich kind of in a way, but it's like you want to be able to communicate. You need to be able to control and keep ourselves healthy, right? Like that is, the body is a piece of real estate if you think of it, right? And we have our physical body and what labor we can provide that could be contributed, but we also have our intellectual capital. I heard someone present that in the room the other day, and that's a smart move. If I have specialized knowledge, like one of the ways that I got myself into the deal with Brian and these guys is that I brought my intellectual and my relational capital to the table. I'm not bringing financial capital at this point, although I wouldn't mind doing that. I'm bringing intellectual, relational, and my experience basically and my network. And that's where I want to see you guys do the same thing. It doesn't need to be years down the line. Like you got to think, who are the top 5, 10, 20 people in my sphere that I can build relationships with, that have the things that I know other people in my sphere need and want, and how can I just be a facilitator in those relationships and connect people and find a way to make it an ethical way to profit, an ethical and legal and moral way to profit in those relationships, because I'm bringing true value. Don't be limited by your bank account. Don't be limited by your experience level. Don't be limited by the things that you don't know yet. Do the opposite. I want to buy real estate with $0. My goal is, if I can find a way to buy real estate all the time with zero money, then I think I'm being smart, right? Not to say that you guys can't use money, because obviously somebody needs to pay the money, put the money, but you want to think like, if I had $0, how would I do this deal? Because money is a infinite resource. In fact, it's infinitely available in the world. It's printed all the day, every day. But bodies are a miracle. Our body was created by God. It's a miracle that we are alive. We have to think and be smarter about this and say, how do I build myself in a way that doesn't require me to be using currency called money?
All right, I hope that gave you some clarity on the difference between income-focused and growth-focused real estate strategies. Whether you're leaning towards passive income or scaling through equity, knowing your priorities is key. If this resonated with you, like the video, drop a comment below with your thoughts and share it with someone who could benefit from this conversation. Thanks for tuning in, and I'll see you in the next one.